Hi everybody, it's AJ speaking. Today I want to discuss the Rivian investment case. Today is Monday. Just a few days ago on Thursday, Rivian reported after hours 4Q results. With 4Q results, management provided significant disclosure changes. There's a completely new segmental reporting. Plus, management provided more comprehensive 2025 guidance, plus also dropped some hints about 2026. As some of you might know, 2026 is a crucial year for Rivian. And as the reason is Rivian is about to launch its mass market, truly mass market product, a SUV, the R2, which will play in the Tesla Model Y segment. And this analysis is about quantifying what this could mean for Rivian. So on this first page, I just wanted to go through some of the key items. And you can see here the last two actually reported years, 2023, 2024, and then a forecast for 2025, 2026, and 2027. The key observation about this forecast is that, first of all, in terms of deliveries, 2025 will be basically flat optimistically, or slightly below 2024's deliveries volume, with significant 2026 sequential growth, or I should say year-on-year growth, to almost 79,000 vehicles, and that is driven by the launch of the R2 platform, which in this analysis assumes a 2Q 2026 launch, and then with further significant volume increases in 2027, driven by further successful ramping of the R2 platform. And then secondly, so quick word on Rivian's new disclosure. So Rivian now splits revenues out into automotive and then into software and services, S&S. This forecast also splits out credits, because credits is a quite important topic. As some of you know, there's a meaningful risk that the new US administrations might affect credit sales in a negative way. They might go away to a significant degree. But in this forecast, we assume latest management guidance, which is pointing towards 300 million in 2025, and then assume some growth, and we will touch on the growth assumptions later when we get to this line item. So the forecast splits out credits, first of all, because it's disclosed, and secondly, it provides a clearer picture of the auto business, and also allows investors to more easily assess what a loss of credits could mean for the business. Rivian's disclosure also allows to separate out the software and services, or as I will call it throughout this presentation, the S&S, into the subcomponents, which is the services and other business, and the VW JV. So the service and other business is very similar to Tesla's services and other, where Tesla reflects all the vehicle maintenance, used vehicle sales, income from body repair, revenue from a charging network. Rivian also has a little proprietary charging network, and Rivian even has some insurance revenue. So it's quite comparable to Tesla's S&O segment, except of course scale significant. Rivian's scale is a fraction of Tesla's. And then the second important component is the VW JV revenue, and this part of the S&S segment is very different, because it's more comparable to a, let's call it, software line item, but we will discuss this in great detail much later in this presentation. So that gets us to the next key observation. On the summary page, you can see Rivian generated a gross loss of 1.2 billion in 2024, and the forecast, in line with management guidance, forecasts a modest gross profit for the full year of 2025. So this is exactly in line with what management said. Management didn't tell us how much, but they said modest gross profit, and I think 55 million would kind of fall ballpark into that range, depending on how you look at modest gross profit. The assumptions of the forecast, again, highly aligned with what management said, implying gross profit to grow to 740 million in 2026, and then significantly increase to almost 2.5 billion in 2027. However, gross profit is only relevant for assessing sort of the scale potential of a business, but to assess underlying profitability, you have to look further down into the P&L. And for that reason, it's crucial to review the OPEX line items. So operating expense line items include R&D expenses, SG&A. So R&D is all your research costs, and SG&A is basically everything else outside expenses for your production. But we'll cover this also in great detail much later. And you can see R&D expenses have been quite massive in Rivian's case. Rivian spent nearly 2 billion in R&D in 2023, in 2024, because frankly, Rivian was kind of running out of money before the VW investment and other things, and they had to scale back their ambitions and to spend 1.6 billion. The forecast optimistically assumes a very modest increase to 1.67 billion, with a further increase in 2026 and another increase in 2027. So the 2025 increase is driven, first of all, management's guidance. Management told us they expect underlying growth of R&D expenses in 2025. So the forecast is perfectly in line with this guidance. However, please note, this is a very modest increase, so the forecast might be optimistic on this point. Another important consideration is in terms of R&D expense growth that Rivian told us that all the associated expenses on Rivian's part in relation to the VW JV is booked in the R&D line, so it doesn't show up in cost of revenue. That's an important point to consider. So you have to assume, as Rivian does more and more work for VW to earn the deferred revenue, which we'll touch on later, there's incremental VW R&D expense in this line item. The next item is SG&A, and here the forecast actually deviates meaningfully from management guidance. Management also told us to expect a year-on-year increase in 2025, but you can see the forecast assumes a slight decrease, and the reason is the following. Rivian currently has meaningful excess capacities in its let's call it selling operations, and I think Rivian is a little bit sandbagging here, because this year they have been guiding, and we touch on this, for probably less than 51,000, and we'll discuss it later why. And this is actually less than what they sold in 2024. So they can sell this volume clearly on the current footprint, because the current footprint sold at volume in the last 2 years. When you look at 2023, they sold actually on a smaller footprint because there was some expansion, over 50,000 vehicles, slightly more in 2024, and hence I don't think it's reasonable to assume there's a significant expansion in that regard, because the business overall is not growing very much. And again, the primary expansion of the business takes place in the R&D line in relation to the JV. So this you might call like perhaps an aggressive or overly ambitious assumption. So this is some optimism bias here in this forecast. And I will touch later in this presentation on why I'm using an optimism bias throughout this forecast. So I stop here to keep these videos short and sweet. Video is almost 10 minutes now, so I hope to see you in the next one. Bye. Hi everybody. Welcome back to part 2 of my Rivian financial deep dive. In part 1, we finished discussing the SG&A line. So we now cover total OPEX. And if we just discuss this line in full, so combining R&D and SG&A expenses, you can see that if we compare the development to 2023, 2024 saw a, let's call it, moderate decrease from 3.7 billion to 3.5 billion. The forecast projects a further drop to just below 3.4 billion, with a subsequent 2026 increase to 3.9 billion. This is driven by predominantly by the launch of the R2 platform, which, as I said before, is expected for 2Q 2026, and with further increase in OPEX in 2027. This is also driven by further expansion of Rivian's vehicle products and substantially increasing sales. As you can see up here, in 2027, the forecast implies almost 160,000 annual vehicle sales, which is a more than tripling of the 2025 guided vehicle volume. So quite crazy growth reflected in this forecast. Keep this please in mind. So with all of that, so what's left for Rivian shareholders operationally? If you add everything up, the operating loss was 4.7 billion in 2024, and the forecast assumes a major drop to 3.3 billion, and a further modest reduction to 3.1 billion in 2026. The reduction is modest in 2026 because when you launch a completely new vehicle platform on new production lines, there are various costs that are being activated, which depress your initial profitability, and this is all reflected here. But I will discuss this in great detail later in this presentation, so you understand how it works. And in 2027, you see a substantial year-on-year decrease in losses, but as you can see, losses are still very substantial at almost 1.9 billion. I repeat, everything you'll see in this, what I would consider relatively optimistic forecast, still translate into 1.9 billion, almost 1.9 billion operational losses. I'd like to further point out that this is actually in line with some high-level guidance management drop with regard to 2027, and we'll discuss this also in detail later. But the operating line, operating loss or income, is not EPS. So we also have to look at non-operating line items, which we'll be discussing later, which are not shown on the summary page, to get to also reflecting tax, which is negligible in Rivian's case, to get to net losses. So, and you can see the key observation here is that net losses actually increase from operating loss to net loss in coming years, and we'll discuss why. Historically, so for example, in 2025, it's almost the same, and I'll discuss why, but then there will be some delta that is growing. And that then drives the EPS, or I should say this is one driver of EPS. The other one is the number of shares outstanding, which, as you will see in this forecast, will be growing quite substantially, and the primary driver will be the VW Group investments. So the share count dilution, as it's called, share count dilution means an increase in the number of shares outstanding, has improves the optics of EPS when your EPS is negative. This is the case here in Rivian. When you look at the EPS, excuse me, you can see in 2024, Rivian generated a loss of $4.7 per share. And this forecast projects a significant decrease in losses per share to 2.9. And this is, so the reduction in loss per share is supported by the increase in share count, because the losses are spread over more shares. But as I will discuss later in great detail, this is highly, highly negative for any Rivian shareholder, because it makes it so much harder to get to an implied valuation for Rivian that makes any sense. And I'm talking about implied valuation multiples, but I will discuss this later because it's a crucially important point. And you can see, it's another key observation is on an earnings per share basis, for the next 3 years, it's basically guaranteed that Rivian on a full year basis will remain loss-making, and significantly so, I should point out. So at that point, I should refer to some of the key observations. Many of them already touched on. But with this loss-making outlook, we should consider, okay, I mean, there's obviously risk factors. As I said, this outlook is on the optimistic side. But let's review what could be some upsides. One upside could be that VW Group decides to expand the JV. However, there's one issue with that. VW Group, even though they're quite large, etc., their financial resources have also been significantly depleted over the last, call it 10 years. First, Dieselgate significantly reduced cash within VW Group. That was replenished by windfall profits from some COVID effects, but a lot of this cash has now been burned on various failed investments, like the over 6 billion investment in the Caria software unit, which has now all basically gone down the drain, or largely, and some other investments. And the cash flow of the group has diminished significantly because the key cash flow drivers of VW Group were Porsche and the Audi brand, and both of these key cash flow drivers have seen significant declines, especially the important Audi brand. This means that VW Group is also in a precarious position and is limited in its own financial firepower, and especially in relative to what it can extend incrementally to Rivian, above and beyond the still outstanding approximately 3.5 billion in funding that has yet to be transferred from VW Group to Rivian. And another potential upside is, as I stated here, that there could be potentially be another, and I call it VW JV-like other partner. So it's conceivable that there's another automaker that shows up at Rivian's doorsteps and says, look, I'm also interested in your EE architecture, can we work together? There's one big problem with that. VW Group formed a JV with Rivian, obviously, and typically in these JV agreements there is some limitation on the partners to extend into additional similar partnerships. This is simply to limit conflicts of interest, because put yourself into VW Group's shoes, you spend actually a lot of money on getting some IP, intellectual property, from Rivian, and if Rivian is working for other OEMs, there's always kind of the suspicion that the company who's developing tech for you could just share the same tech you paid for with another partner, and that's why companies are always highly cautious and try to, in their contracts, exclude such possibilities. And for that reason, and I worked on JVs in my professional career, I think this is a low probability outcome that there's another significant partner similar to VW Group coming into the Rivian nexus. Lastly, takeover considerations. I'm an ex-M&A professional, so I know a bit about this topic. When you talk about takeovers, you always have to think about one, acquisition premia, and you can easily check it by looking up acquisition premia, which is somewhere between 30 and 40% of the what's called undisturbed market value of the company. So say Rivian drops to a 10 billion market cap, so the acquisition ticket would be 13 to 14 billion dollars. Given Rivian's massive net losses, which wouldn't change dramatically under new ownership, at least not over the short term, like 12 months, the dilution to any automaker because of the large implied ticket size for Rivian would be enormous. And no board, I guarantee you that no board would sign off on that. So unless Rivian drops, and just pulling this out of thin air, drops at least a 50%, nobody will even consider that move. So this video has already become kind of long, and I want to keep these videos short and sweet. So I stop part 2 here, and I hope to see you in part 3. Bye. Hi everybody, it's AJ speaking. Welcome back to my series on Rivian. This is part 3. In part 2, we finished off discussing some of the upside risk factors for Rivian, but we should also briefly discuss some of the major downside risk factors, and we'll touch on those later in the presentation again when we discuss the respective financial disclosure line items. So a very big risk to Rivian is that the new US administration negatively affects the emission certificates trading in the United States. So any kind of demand impact for such CO2 emissions certificates, or for short credit sales, would have a major profit impact on Rivian. The reason why the impact on Rivian is actually much more pronounced than it would be for Tesla is because Rivian is extremely US concentrated. Rivian's market is essentially the United States and Canada, and there's virtually nothing beyond that. And the vast majority of Rivian's global market is comprised of just the US. That's highly concentrated, while Tesla has not only a globally diversified auto business, and in fact Tesla's largest auto market is now China, but on top of that, Tesla has a quickly growing energies business, has a much larger services and other business, then of course there are prospects of becoming a robotics leader, FSD, etc. There are a lot of things that make Tesla like day and night differently positioned than Rivian in that regard. So the risk, the relative risk to Tesla and Rivian is absolutely not comparable. For Rivian, this is a really big deal. For Tesla, I would call it mostly a bump in the road in the short or medium term. Because I'd like to point out Tesla's credits income is not just driven by the US, because such schemes exist widely in Europe, but also even in China. So Tesla's credits line wouldn't go away, probably not even half, even if the US axed most or all of the credit sales. But this video is not about Tesla, but the reason I use Tesla because it's the best analog in many ways for a number of these things, obviously because Rivian US automaker, Tesla US automaker, pure play EV maker, Tesla pure play EV maker. So Tesla is the obvious comparison. So the other major effect, and which I've seen not discussed that much, is actually the IRA manufacturing credit. So EV makers making batteries and electric vehicles in the United States, they get actually quite substantial manufacturing subsidies. And if that one was to go away, that would also be a major blow to Rivian's automotive gross profit, because it would increase costs of production. Since Rivian can take these subsidies and offset some of the production cost. So the production cost that you see in the financial disclosure is actually reduced through these manufacturing credits. The other very big item is that Rivian loses this very large Department of Energy loan of 6.6 billion. So this forecast assumes Rivian fully gets this loan and in a timely manner for increasing production capacity for the second factory. But even if Rivian gets the full loan, there are some other risk factors. It's conceivable that there might be some modifications to this loan under the new administration. A lot of people talked about the why the US taxpayer is not participating in the upside of companies. It clearly helped to grow, and there's an argument the US taxpayer should have some equity share. So if there was the implementation of an equity portion into Rivian in exchange for getting this very large loan, then dilution in Rivian would substantially increase, just because of the scale. Look, if the government just asked Rivian to get like a 10% stake in Rivian in exchange for getting this loan, Rivian would gladly take it. I can tell you that. And the reason is that Rivian is already very highly levered. Rivian has about 4.4 billion in debt, and the debt over the forecast will go up because the forecast also accounts for the announced VW debt injection, and we'll discuss this later. So Rivian said it's going to go up, and the problem is Rivian's balance sheet total equity is, because of negative free cash flow, consistently decreasing, and this is driving up another key credit profile metric, which is debt leverage. And if you want to get a loan from a bank, or want to issue a bond to access reasonable priced debt in the market, you can't have too much leverage. Otherwise, people will ask a huge risk premium. And right now, I think given the large leverage and also the loss-making outlook, banks would charge incredibly high rates, and also a bond would be rated like junk, and would also carry a very high coupon. So that is not really an option for Rivian anymore, because the leverage has become just too high. So Rivian really needs that government loan. In addition, because the only alternative would be another capital raise, and given Rivian's very large capital needs, as you will see later in its presentations, relative to its current market value, the capital raise would have to be quite substantial. So this entire forecast is built on getting this DOE loan without any significant modifications. But this is a huge risk factor. So any investor, please pay attention to any news on that item, because that has a major impact on this forecast, and it's only negative, I can tell you. So with that, we already kind of touched on free cash flow. So free cash flow, just a really quick recap. So free cash flow is simply your operating cash flow less what you spend on capex. Capex is basically all your investments in tooling, equipment, buildings, so all the long-term assets that help you make the product. And you can see here Rivian's capex spend, there was just over $1 billion in 2023, 1.1 billion in 2024, slight increase, and then there's a material increase for 2025. This is based on the low end of Rivian's guided range. So Rivian is guiding for 1.6 to 1.7 billion in 2025. So the forecast, as I said before, has an optimism bias. And whenever Rivian provides these kinds of metrics, the Rivian has like an optimistic view on it, and that's why we only assume 1.6 billion, but keep in mind it could be higher, slightly higher. And then Rivian also told us that they expect a year-on-year increase in capex spend from the 2025 level, and that's why you see this increase, and this is kind of expected because Rivian launches the R2 platform, so there a lot of tooling, and so in the first quarter of 2026 a lot of tooling will arrive at the new factory. Bills are basically being paid, and lots of things like that. You can always see this with Tesla when they put up a new production line. A lot of stuff arrives in the last few months prior to launch of a new product. So that's why it's completely natural to see this spike. So the forecast assumes, as you can see over here, a 20% increase, but keep in mind 20% looks like a lot, because we are assuming the low end of the guided range. If we use the higher end, for instance, the 1.7 billion, or the midpoint, for example, from the midpoint 1.65 billion, this would only be a 16% increase. So anyways, this might look to you as minutia, but still has a meaningful impact on free cash flow, which, as you can see, is massively negative, and a big driver is capex. But you can also see that the by far biggest driver is operating cash flow, and because the video already kind of got long, I stop here and we'll discuss operating cash flow in the next part 4. So thanks for listening, and see you in the next one. Hi everyone, welcome back to part 4 of my Rivian deep dive. We abruptly stopped at discussing free cash flow, operating cash flow, and again, free cash flow is the result of operating cash flow less capex. So you can see that in 2024, free cash flow was a negative almost 2.9 billion, and 1.1 billion of that came from the capex spend. In 2025, based on management guidance, as we discussed, it's 1.6 billion negative, let's call it drag, from capex, but the total free cash flow is a negative 4.3 billion. So there's a substantial other driver, and the main driver we can already see on this page, because the sort of the starting point in operating cash flow calculation, and we'll discuss this in very much detail later, is the net loss. And you can see the net loss was 3.3 billion, and so you can do like a very quick rough proxy of free cash flow if you just look at net income or net loss. In Rivian's case, it's a net loss, and add capex. That gets you to, in this case, 4.9 billion, which is not day and night different from the ultimate free cash flow number. Again, I don't recommend using this method all the time, but a quick high-level view gives you a rough estimate. So there are some other drivers, and we'll discuss them, but the big picture is this negative free cash flow is driven by continuing net losses. So every time the CFO talks about non-cash charges, to be honest, it's kind of a red herring in this direction. So with that, we should look at how the cash balance, and keep in mind cash balance should not just be, cash and cash equivalents, or the cash balance as it's shown on the face of the cash flow statement. You should always look at the balance sheet, and you should consider how much short-term investments is there, if any. And in Rivian's case, this changed over time, but bottom line is including all liquid assets. And that's the correct way of looking at this, is significantly decreasing, and you can see this here. So 2024 closed at 7.7 billion. By the way, I forecasted mid 2024 for end of 2020 7.6 billion. So I was right on the money, just saying. And it basically then drops to 6 billion, significant loss, and the main driver is the free cash flow. So so financial professional might look at this, oh, wait a second, AJ, if I start with 7.7 billion in 2025 and I end at 6 billion, that's 1.7 billion less, but you're telling me negative free cash flow is almost 4.3 billion. So where is the delta? Because it should drop by 4.3 billion. The explanation is this forecast fully accounts for all of the announced VW Group capital injections, and there are quite a few of them, and also includes a timely release of the DOE loans. And only because of these two huge capital providers, Rivian's cash flow is not turning very quickly negative, i.e. bankrupt. But you can see, even despite this massive funding from the DOE and VW Group, because the business is so operationally loss-making, Rivian is still falling short of capital in 2027. Because by my estimate, Rivian always tries to maintain round about 7 billion in cash, and for someone like Rivian with massive cash burn, this is where you want to be, because people always comment in posts that, oh, Rivian sits on so much cash, they can't go bankrupt. This is not how it works. Once an automaker gets into what's viewed a low capitalization state, in Rivian's case, that would be probably no later than at 5 billion, probably sooner, people would price in capital overhang, i.e. companies capital undercapitalized, even though at 5 billion would still be far from bankruptcy, of course, but it would only be, because of the huge cash burn, only several quarters away. So people would start pricing in the dilution because they know a capital raise is coming in some form. And the problem is, the longer, like from a CEO's perspective, and I advise CEOs and CFOs in my career, you always want to look at, okay, what's like the kill zone for my company? Let's say in Rivian's case, that would be probably, the kill zone would be 2 billion. I'll explain in a second what the kill zone is. Then you want to add like market buffer where the market kind of gets crazy on you, add another 2 billion. So you're at 4 billion. 4 billion is where the shit really hits the fan for you as a company. But as a CFO, you want a risk buffer on top of the shit zone, 4 billion. And that's why you add another risk buffer. In Rivian's case, it's around about 2 billion. That's why you get to a minimum of around 6 billion. And that's why the minimum for Rivian is like where you feel comfortable as an executive is more like 7 million, because the moment you go below 7 billion, you kind of start trending into your risk buffer. You deplete your risk buffer, and you know once you get kind of to the shit hits the fan zone of near 4 billion, you're really in trouble. And the problem is, once you get into that level, there can be a quick spiral downward. And God forbid, if you are then forced to raise equity or other types of debt, and you have like bad market conditions, I don't know, some conflict breaking out, big one somewhere, and the cost of debt that you can raise explodes, or the market might be, I don't know, not closed, but it might be very difficult to raise equity at some reasonable amount of discount. I mean, there's always a discount when you raise equity, especially for a company like Rivian, but your discount to TERP, that's the technically correct way of looking at discount. So the TERP is the theoretically ex-rights price. I'm not going to explain what it is because it exceeds the scope of this presentation, but bottom line is, shareholders suffer enormous dilution. So to prevent all this risk, you always want to have like a healthy cash cushion, and that's why, unlike many laymen think when they see like several billion in capital, this is not that much in reality, given all these risk buffers. So this risk buffer concept is crucially important to understand in assessing the minimum effective capital for a company. In Rivian's case, based on my experience in decades in the industry, I would say this is probably 6 to 7 billion minimum. And now you see like one huge weakness in this forecast, because you see, well, AJ, you're telling me Rivian needs to hold 6 to 7 billion, but you're also showing in this forecast that the cash balance goes down to 4.4 billion in 2026, and even 2025 looks a little close to what you just explained at 6 billion. And then look at 2027, it's even dropping below 2 billion. So this means this forecast is very, very optimistic, because as I said before, I'm accounting for the DOE loan, plus all the VW Group capital injections. This means over the next 3 years, there will be other capital raises coming from Rivian. This is basically, if you believe this forecast is somewhat accurate, and we go through everything in detail in the later parts of this series, there is no way for Rivian to get away with more capital raising as the latest set out. That is not on the table. This means another capital raise, and it will be a dilutive one, of course, is unavoidable. And given the implied magnitude of the capital gap here, if we just keep the 7 billion in mind, because the thing is, when you raise capital, it's another point people never really think about. The capital raise is not back to your minimum level. The capital raise is always intended to raise the level to a level that gives you at least 3-4 quarters of runway before you yet again touch the critical level. So if you apply this logic, then you can see that here in 2025, if you want to be near the 7 billion level, you need to not only raise, let's call it 2.5 billion to get to 7. You need to raise probably more, something like 4. However, there's one big uncertainty. We don't exactly know the release of the DOE loan. If the DOE loan is released mostly already in 2025, because I expect some share to be released upon achievement of certain milestones in 2026. If the DOE loan is released early, mostly in full, then they can avoid in 2025 another capital raise. But if my working assumption is correct, there might even be a raise in 2025. So keep that in mind. But even with the DOE loan fully paid, basically the forecast implies that Rivian has to come to market in 2026. So my assumption is what's going to happen is it doesn't really matter when the DOD, it does matter when the DOD loan is being paid, but RJ, Rivian CEO, will basically jump on any opportunity in the market where he can raise more equity at attractive terms. So with that, this is the end of this part 4. So I hope this was informative. Hope to see you in the next one, part 5. Thanks. Hi everyone, welcome back to my deep dive into Rivian. This is part 5. In part 4, we stopped about the capital development in Rivian, and we talked about potential raises, some of the ramifications, but I would like to emphasize why that is so important. When Rivian raises capital, and as I said, it can only be equity, it will yet again increase significantly Rivian's share count. This makes any future profitability in years 2028, 2029, etc. much less valuable, because you're dividing every dollar in earnings over a much higher number of shares. That's what it ultimately comes down to. And as soon as the market basically takes note of that, the pricing in starts. And this was the precise reason why we saw kind of the long-term lows in Rivian stock in early 2024, because people finally realized, okay, Rivian is running out of capital and they're coming to market soon. Business is not doing well, and they priced in the dilution. And then once the VW JV was announced, share price spiked up again, because now this what's called capital overhang was removed from the stock. So I anticipate the exact same scenario in the not too distant future. Right now it seems like everybody thinks like, Rivian is sufficiently capitalized because of this huge DOE loan, plus of course VW investment, all things is good. But as you'll see, when you model everything in a consistent manner, you can see there's still a significant capital hole. So with that, let's just look at sort of the margin development. So the total gross margin in 2023 was 46%, improved to 24% in 2024. I expect, or I should say the forecast implies a modest 1% gross profitability. And again, this is across the entire business, not just auto. And that improves to 9.6% in 2026 and 19.3% in 2027. So that is actually a pretty good gross margin for an automaker. I'd like to point out one important accounting distinction. Some automakers move R&D into cost of revenue. This means all these automakers show a higher cost relative to other automakers reporting R&D expenses in OPEX. This means when you compare one who does that and one who doesn't, the one who does include R&D in cost of revenue understates the apples to apples gross margin. And this is the case often in European automakers. However, one thing that European automakers use to offset that effect is a large capitalization of R&D expenses, which US automakers or US companies in general typically don't do. But this is also exceeds the scope of this presentation, but I'll discuss this in another analysis. But just keep that in mind so you're not falling for the obvious traps in terms of financial analysis. So then when you look at sort of the individual segments, auto, S&S, and I also break out credits because I find credits because they're pure profits, they're really pure profits, highly noisy if you include them in these product lines, and especially given the changing environment politically in the US and Rivian's dependency on credits. So when we look at auto, the picture is not quite as favorable as the total gross margin would imply. Auto in 2024 was 39.7%, and by the way, the reason why I'm not showing auto gross margin for 2023 is Rivian significantly changed its segmental disclosure, and we do not have enough information to break this out in a consistent manner. And that's why before I show you apples and oranges, I rather not show you the number at all. But I can tell you this was also deeply negative. So then in 2025, there's a substantial improvement. So this is driven by, and keep in mind 2025, there's still only the R1 and van platforms. And the forecast assumes continuing strong ASP, so ASP is average selling price development, driven by a strong mix. The CEO talked about the high take-up of the new three-motor version, and there's also a quad motor version, but they have some problems with that one. But anyways, so the forecast is optimistic on this part, so strong ASP, plus Rivian can continue to take out cost from production cost, and Rivian also talked about this on the earnings call a few days ago. They said they expect throughout 2025 a continuing strong raw materials, or they call it commodities tailwind. So the forecast accounts for that. Forecast also takes into consideration Rivian's comments around the mix relative to consumer and commercial vehicles. So commercial vehicles comprises Rivian's delivery van. And then 2026, there's a significant further improvement. And this is based on an assumed continuation of the favorable trend of the R1 and van platforms, so continuing strengthening of ASP, improving production costs, plus the onset of the R2, which is assumed to hit profitability only 3 quarters after ramp, but we'll discuss this in much detail in a later part of the series. And then the forecast, so this gross margin improvement in auto to 13.2% in 2027 reflects that the R2 really takes over kind of Rivian's business, just as the Model Y did in Tesla's business. I mean, first there was the Model S and X, and then the Model 3 took over, and then later the Model Y took over from the Model 3, and this is kind of what this number also reflects here, but we'll discuss this also in great detail much later. Then we look at the software and services gross margin. Keep in mind that this comprises services and other, which tends to be a low margin type of business, and VW JV. Here there is an issue with that gross margin, and I cover this later in the presentation, but for now let's keep it simple. This reflects Rivian's guidance. The CFO said that Rivian expects for the whole of this segment a quote 30% area gross margin. So the the forecasting reflects it, but she made one comment that actually conflicts with some other comments she made. But I'll discuss this later. Then you have credits. Credits is, you see here, crazy 100%. Why? Because it's just revenue minus no cost equals profits. That's why you have 100% gross margin. And then ultimately taking into consideration R&D and SG&A expenses, you get to operating margin reflecting all the costs almost. And you get so in 2024, the operating margin was negative 94%, which is like insane. And I mean, keep in mind this business has been selling now vehicles for over 3 years, and anyway, let's not get into that. But in 2025, based on all the assumptions of the forecast, we dropped down to negative 59%, which is still crazy high. 2026, just over 40%, and 2027 still almost negative 15%. And again, this is really, really bad. And then when you look at the net income margin, it's even slightly worse because there is some effect in the non-operating line items, which are not shown on the summary, that are driven by the depletion of the cash balance that drive a loss of interest income, which was actually quite an important item for Rivian earnings, because Rivian, relative to its business size, sat on a huge cash pile, but that cash pile has been burned. So with that, this was part 5. I hope this was informative again, and hope to see you in the next one. Bye. Hi everybody, it's AJ speaking. Welcome back to my series about Rivian. This is part 6. By the way, it blows my mind that it took already 5 videos to just discuss the executive summary. I promise to do better throughout the rest of this presentation, otherwise this will take days to go through, because there are 30 more slides, or 31 more slides. So let's start with looking at the total revenue line. You can see here the revenue development. In 2024, Rivian generated almost 5 billion in revenue. Forecast implies 5.6 billion, growing to 7.6 billion in 2026, and then in 2027, revenue kind of explodes to 12.6 billion. Just as a point of reference, Tesla generated in 2024 roughly 100 billion, or is 20 times larger in terms of revenue. So you see there's quite some variability from quarter to quarter. This just reflects, because this model is highly bottom-up, it doesn't use any big top-down assumption drivers. So the seasonality is reflected in all these numbers. For example, in 1Q, Rivian told us they only expect 8,000 vehicle deliveries. Of course, the forecast then reflects this guidance. But then also the rest of the year is based on a quarterly projection with a view to be in line with Rivian's full year 2025 guidance, while accounting for various Rivian factors like factory shutdowns, etc. So the forecast overall, and this goes for everything in this forecast, tries to be in detail as accurate or as close to a realistic real-life scenario as possible. So this slide 2, shows the same thing, total revenues, but this time broken down into the 4 key business segments of Rivian. And just to recap, this is the auto business excluding credits, the credit sales, services and other, and the VW JV. The two that are very different from the rest of it is obviously credits and VW JV, because these two segments have a very, very high gross margin relative to the other two main revenue drivers, that is auto and services. So auto is the lion's share. So for example, in 2024, in the fourth quarter of 1.7 billion in total revenue, 1.2 billion came from the auto business. A major 300 million outlier credit sale that was clearly a one-time one-off, because management guided for 2025 full year for just 300 million. So recognizing in one quarter 300 million is clearly not a base for quarterly extrapolation. And then services provide roughly 95 million, and the rest included VW related revenue. There was some revenue flow, even though this slightly conflicted with some CFO commentary. The reason is, she said that the service and other has a baseline of around 100 million, and but the total revenue was about 214 million. So there was some other items. So the bottom line is, I think what happened is there were some other items that are not part of service and other and are not really part of VW JV, so some one-offs, but they haven't disclosed what it was. But long story short, I had to bucket these revenue items, so I decided to go with the rough baseline estimate of the CFO. I show 95 to 100 million for some detailed factors I can't get into, and then the implied sort of the plug had to be the VW JV. But anyways, this is a minor detail. Then just on how this works real quick, I basically drive the auto revenue by looking at a volume forecast, applying trim weighted average prices, and this gives me the revenue line. And then for credits, I take basically management's guidance extrapolated. Service and other, I heavily lean on Tesla's service and other segment as kind of an analog for the development and some of the key insights we can take away, since this is very similar to Tesla's, just on a much smaller scale. And then the VW JV, we know that over a 4-year period, Rivian wants to release the deferred revenue, but we'll discuss it later. So this is also, you can, because of that guidance, you can quite well forecast how this will unwind in Rivian's P&L, which you see over here. So then when we dive into the main revenue line item, which is auto business, excluding credits, you can see in 2024 the business generated about 4.2 billion. That basically stagnates in 2025. The reason is, as I said earlier, volume is not growing, actually probably slightly shrinking, and the mix change sets off some of the pricing effects. So therefore you have a very modest revenue growth. However, things change in 2026 with the launch of the R2 and some expectation of volume growth in other products. So you get to 5.8 billion, and this grows then kind of explosively to almost 10 billion in 2027, as the forecast assumes a highly successful ramp and launch of the R2 platforms, R2 vehicles. Just by the way, the forecast assumes that Rivian will be launching trims that are comparable to Tesla's Model Y. So Tesla has a rear-wheel drive version, long-range version in US, and a performance version. And the forecast assumes Rivian will do exactly the same, but obviously they will call it something else. And also the forecast assumes that Rivian will launch into the market positioned in terms of pricing slightly above Tesla across all these trims. So the next revenue item is, as we discussed earlier, credit revenue. I discussed this already in earlier parts of this series. There's a significant risk associated with this line item, that it could go away or be trimmed back. In terms of modeling, what I decided was I take management's guidance of 300 million, look at what this implies on a per vehicle unit basis, which is 5.9K. So Rivian receives about $5,900. This might look quite high relative to other automakers that receive credits, but keep in mind that Rivian vehicles, they sell in a let's call it bigger vehicle category, and therefore the emission certificates you earn are actually higher. At least this is my current understanding of the framework. So basically what I did is I assumed a slight haircut to the value of these credits. So I put this down here. I assume a reduction to 4.7K in 2026 per vehicle delivered, and then a further reduction or a significant drop to 2.8K in 2027, and the significant drop here is driven by a significant change in vehicle sales composition, because keep in mind in 2027 the R2 completely takes over the volume contribution in Rivian, and that's why and I expect the R2 comes, and we know will come with a significantly smaller battery, and hence it's a smaller vehicle class, etc., and therefore will earn fewer emissions credits. So this is modeled on a volume weighted basis. and again reflect some haircut, because right now I think this is probably the most likely outcome under the current administration. Plus within the legal framework, because you have to keep in mind that large states like California, which is the by far biggest market for Rivian, they might have their own regulation, even if the current US administration kind of axes the emission system more broadly across the country. California, there's some meaningful likelihood they would come up with some compensatory measures. So to kind of bring this all into this forecast, I make these haircut assumptions to the credit revenue. So, but big picture, I view credits more as a risk item to Rivian than a upside item at present. So this brings us to the end of part 6. I hope this was also informative, and hope to see you in the next part 7. Thank you for listening. Bye bye. Hi everybody, welcome back to my deep dive into Rivian. This is part 7. In part 6 we ended discussing credit revenues. Let's jump now to the next big segment. This is services and other, and just to recap what service and other contains. The primary driver is used vehicle sales, also revenue from vehicle repair and vehicle maintenance, charging revenue. So Rivian also owns some chargers, and whenever people charge there, they make a little bit of revenue, but this will be a minuscule revenue stream for Rivian, so barely worth mentioning. There's some software subscription revenue Rivian receives from owners, similar to Tesla. And I'm not talking about FSD. And then there are other services included. That there's also an insurance program that Rivian is running in association with an insurance company. And there is also some revenue Rivian extracts from financing. So this modeling of this segment was significantly based on key lessons we learned from Tesla's services and other segment. Because if you look at the items that are included, they're very similar to Tesla, so the composition is very, very similar, just of course a very different scale. And what you, for example, one key takeaway in Tesla's S&O segment development is that segment consistently grew quarter by quarter. And the reason is very simple. As you keep selling cars, your vehicle fleet keeps growing. So the number of vehicles that potentially need, service, repairs, etc., keeps growing. And that's why it's only natural that revenue just consecutively keeps growing. And actually, here on this chart, you can see the development of Rivian's global, or I should say North America, vehicle fleet. Rivian closed 2024 at 123,000 vehicles, and over the forecast horizon, so next 3 years, that fleet is almost quadruples, which represents the primary driver of, and you can see the totals down here, the primary driver of the full year 2024 revenue, 365 million to almost 1.5 billion increase in 2027. Overall, just like in Tesla's case, it adds to the revenue line, but because of its typically low margin nature, is not a primary driver of the business. Then we come to the last revenue driver. This is the VW JV, so the VW group announced in June 2024 the intention to form a JV, and said they need to confirm certain technical details before they can finalize the deal. Then in November 2024, it was announced that the deal was finalized. With that, it was also announced that the initially planned roughly 5 billion of VW Group investment was increased to 5.8 billion, so roughly 800 million, let's call it 800 million increase. And when you look at the financial modeling of Rivian, I think you see kind of why it was increased, because Rivian is still weakly capitalized, and Rivian is of no use to VW if the company gets into trouble. So they want to make sure they stay on they are on sort of solid footing, at least for the next few years, because also VW has now a significant stake in Rivian equity, and they're also not keen on seeing too much dilution in that stake. However, as you can see in these numbers, it's still highly likely that Rivian, at least in 2026, has to raise more equity. But yet again, VW also doesn't have infinite access to capital, and they're also somewhat limited, because VW Group is paying a dividend, and cash flow is very low, so they are also in kind of a pickle. Important note in terms of this revenue stream. So the CFO said that the disclosed 1.96 billion in deferred revenue will be distributed over an approximate 4-year time frame, and this revenue release was back-end loaded. So let's just decompose what that means. So 4 years, there would be 16 quarters, and back-end loaded means that the majority would probably take place in the second half. And and they also said we should expect to kind of ramp up. So the forecast is actually a lot more aggressive on this, and makes 2 significant changes. One, the forecast assumes the full deferred revenue is released over a 3-year period, so 12 quarters. This means you see the effect of the full release fully within the forecast time period, because the forecast, as you can see, is for 12 quarters. The forecast also includes what's called a sweetener. Often in these deals, I worked a bunch of these in my career, there is, people call it sweetener. It's basically a clause that says, or I should say an incentive, for the partner to basically try to give their best effort to earn that incentive. It's literally just like a bonus. Just like when you incentivize an employee, you pay them a base salary, but because you want to extract maximum performance, you put this carrot in front of them. The exact same strategy is applied to these business deals, where companies say, okay, please deliver these performance milestones, but if you outperform these milestones, we give you extra. And in VW's case, they have a huge interest in getting the EE architecture from Rivian incorporated in their vehicles ASAP, and given the accelerating vehicle timeframes, which are driven by the competition from China, I think this was, to be honest, BS from the CFO. She just was sandbagging this point, because I don't think VW said, oh, okay, let's have something in 4 years. No, we want something over a meaningful time frame, and even 3 years might still not be aggressive enough, to be honest with you, given the situation everyone in the auto industry is in right now. That's why I feel quite comfortable accelerating this guidance. So yet again, the forecast in this point at least meaningfully exceeds what Rivian guided towards. So now we covered all the revenue items, and now we jump to cost of revenue. So here right now you see the total cost of revenue. This number on its own is completely pointless, as every analyst will tell you, because you need to look at this in terms of margins, etc. But I'm just showing you the development. This is kind of meaningless. This is more interesting. Now we've split it down into the main segments. But as you would expect, the vast majority of cost of revenue is situated in the automotive segment, and with an increasing amount in the software and service. But keep in mind, all the VW JV-related cost is booked in R&D, which is down here, in operating expenses, not in cost of revenue. That's kind of the key point here. So the cost increase that you see here in the service and other segment, software and services segment, is really all, as it's stated here, services and other, not the overall big segment. Again, service and other is a sub-segment of the main segment, software and services, but it's all driven by service and other. So this means all the Rivian service infrastructure. I'm sorry, not service infrastructure. Sorry, I'm talking rubbish here. That cost is driven by running and operating the service infrastructure. That's the correct way of putting it. This does not include any investments in the service infrastructure except for the depreciation charge. So next slide, let's dive into automotive cost of revenue. Here again, this number is yet again kind of irrelevant without putting it into perspective, but I'm just showing you here the development. This also reflects like variations in depending on seasonality, etc., vehicle delivery volumes. And then you see here finally the interesting bit. But because this part 7 already got kind of long, I stop here and we'll dive in. We will start part 8 from this slide. Thanks for listening. See you in the next one. Bye. Hi, welcome to part 8 of my Rivian deep dive. So we stopped at looking at automotive cost of revenue. Now we want to dive into sort of the more interesting bits. On this chart, you see the average vehicle production cost assumption by main product category or platform, as it's quoted here, stated here. And so this is shown in thousands of US dollar. And when we look at Q4, Rivian's average production cost for the R1 and van platforms is $99,000. And I just want to point out why this is combined in this analysis. So fundamentally, it makes not much sense to combine the R1 platform, which comprises the truck and the SUV, which are also higher end vehicles with almost $90,000 average vehicle selling prices, with the van, which is a Amazon delivery vehicle, which I mean, there are vans, quite pricey vans, but still completely different categories of vehicle. The only reason why I combine this, because management always shares numbers, or most of the time, that combine these two, and to make forecasting vastly easier and to avoid making assumptions on assumptions on yet these assumptions again, it's just better to just lump them together and model them as once. So with that out of the way, if we look at the development of the R1 van platforms, average production cost development, you can see that the forecast assumes, let's call it a consistent, at least around about $2,000 sequential cost takeout, which is ambitious, but certainly achievable, especially given Rivian's guidance of commodities tailwind. But what limits progress is that the volume is not increasing in 2025, plus might actually decrease, but we'll discuss it later. And so this forecast is probably quite realistic. Where it gets increasingly perhaps too optimistic as we move into 2026. And the reason is, it sounds to me that RJ, once the R2 launches, is keen on maintaining the R1 and the R1 truck and SUV more as kind of the premium end of the brand. He called it like the handshake to the brand, I think was the wording he used, and it makes kind of sense of having this more premium, to have something aspirational for people who are new to the brand. But there's a lot of marketing stuff I'm not going to go into here in much detail. The bottom line is, because they will keep it premium, I'm not sure how much they can bring down production cost on realistically, because that would at some point mean to remove some of the bells and whistles from the vehicles, which I think that clientele loves dearly. Then you look at 2026, and we see the launch of the R2 platform. And keep in mind, the R2 is like, in terms of vehicle category, comparable to the Model Y, size-wise, etc. And you see here quite a high production cost initially. This is completely normal, because in the beginning you have very, very low production volume, but it's quite common that automakers in the US depreciate production tooling, machinery, etc. on a straight line. So the depreciation charge is actually not driven by volume, as it is often under IFRS accounting, for example, in European automakers. And that's why the depreciation charge is huge when you have very small volumes, and that just drives the cost up significantly. And then there are other similar effects when you have very small volume. Plus, of course, all your operators, they're not skilled yet in putting the vehicle together. It takes them a little longer than once they did 10,000 of these units, they can put together the vehicle blind. Plus, in the beginning of times, there's always fine-tuning of the production lines. There are always issues you need to solve, etc. So you have always kind of this ramp curve. Even the best automakers take typically at least a couple of quarters before they dial everything in. Then industry-wide, on a new production line, I need to point out, on a new production line, a new vehicle, which is the case here, if you can make the vehicle if you can achieve gross profits within 3 quarters, you're doing actually quite well. And this is the underlying assumption in the modeling that you see here. So basically, this production cost after at the end of the third quarter, after the R2 launch, lines up with the volume weighted average price of the trims that Rivian is going to sell in that quarter. And on this slide, we put this into perspective. On this slide, we look at the gross margin by product platform. So the R2, I optimistically assume they have a negative gross margin in the very beginning, which is quite optimistic. Often it can cost twice as much to make one vehicle than what it can sell for in the very beginning because of the effects I mentioned earlier. I expect a significant sequential improvement, and then to hit this magical break-even point where they actually don't lose money anymore on selling these vehicles as volume ramps, and then it keeps ramping. And you see in the curve here this little drop in, let's call it velocity, and or the first derivative is decreasing, and the reason for that is the seasonality effect. 1Q, because of winter, etc., tends to see slowing in progress, and the forecast tries to account for that. And just real quick on the R1 and Vans platform, you can see that in 4Q 2024, the margin that was reported was 15.5% negative. And the forecast projects a sequential further decrease to 19.3%. And the reason is driven by a significant decrease in sequential volume as Rivian guided to, because yet again, when the volume drops, your depreciation and some other charges spike up on a per vehicle unit basis, and that's why you see this temporary slowdown in improvement. But then the forecast continues with sort of an optimistic development. Again, this is based on a optimistic price assumption and continuous cost improvements for the R1 and van platforms to achieve a gross profit before credits and anything else sometime mid 2026, and you can see here the number for the third quarter 2026 would be 0.5% based on the assumption of the forecast. Of course, the real number will not be exactly that number. That would be quite amazing, but this gives you ballpark sort of a sense of what I often call the opportunity space. Opportunity space, I think, for the R1 van platform is quite limited. And also when you look at the opportunity space for the R2 platform, the forecast projects the vehicle gets to a 22% gross margin, basically end of the second year, so in 2027. So let's talk about it for a second. That is a very high gross margin, and sort of the Rivian boys might say, oh, but Tesla touched 30% as the Model Y was ramping up. But they completely forget one thing. When Tesla ramped the Model Y, there was no other Tesla in the market. Rivian has to compete against Tesla. But when Tesla launched or scaled the Model Y, there were also some other one-off effects. For example, COVID was a significant margin booster, and I'm not going to get into detail why, because this video would become way too long. Rivian probably not going to see another kind of COVID effect. Plus, of course, there are now lots of other, at least to certain customers, comparable or competitive alternatives in the market. There was a huge influx of other electric SUVs. So this was a long-winded way of saying that the competitive environment, once, keep in mind, the R2 hits in scaled in basically 3 years from now to a major volume, faces a completely changed competitive environment compared to when Tesla managed to deliver with the Model Y very high gross margins. So I think, to be honest, it's completely unrealistic that Rivian can achieve anything more than what you see on this chart right now, given this change in competition. On top of that, Rivian simply doesn't have the money to make anything competitive in autonomy. So this also limits in various ways. So I think the forecast with this gross margin projection is actually very, very aggressive and or highly optimistic, and also something to keep in mind. So with that, I will wrap up part 8 of this series and hope to see you next one. Thank you for listening. Bye. Hi everyone. This is part 9 of my Rivian deep dive. In part 8, we wrapped up with discussing the optimism built into the gross margin assumption of the R2 platform launch and ramp up. On this slide, I want to discuss a somewhat a slightly complicated point about Rivian's guidance and in some what I consider irreconcilable differences. So big picture. So there is one of the two big segments is software and services, or short SNS. And SNS has two components, services and other, and the VW JV. Management told us to expect for the whole segment, SNS, a 30% gross margin. But here's the problem. Management also told us that they expect VW JV revenue to be pure profit. Pure profit means 100% gross profit margin. On this chart, you see a much lower margin. It's ramping up quite a bit, but it's much lower than 100%. It's just here, like in the 40%, and then going all to almost 70% by the time the revenue is paid out, almost paid out. So the reason why I cannot use a 100% gross margin is the following. The services and other component is a very low margin type of business, but it is profitable. We can work out that the margin they brought in recently was, in fact, already it's not shown in this chart, 4.7% in 4Q 2023. And the fleet, which is driving that segment and other things, has been growing since then. So we know it's profitable, but not deeply loss-making. And the reason why this observation matters is the following. If you set the VW JV revenue at a 100% gross margin and run a modest profitability for the services and other segment, the numbers don't add up. It's way more than 30%. So something has to give. So you have the following choice, mathematically or counting-wise, whatever you want to call it. You either follow management guidance, you set it to 100, so the VW JV revenue, and you assume deeply negative services and other segment to get overall to a 30% gross margin, or you do as I do in this forecast, you assume a reasonable margin. I mean, 10% is a bit ambitious, but possible because Rivian is charging a little bit expensively for their services because it's expensive product and typically automakers take advantage of premium customers. But anyways, let's not go into the detail. But bottom line is this is a sensible margin assumption. But by using the sensible margin assumption for the service and other segment, we have to lower the VW JV margin assumption. Because if we don't, the margin for the overall business, combining these two subcomponents, is significantly higher than the 30% the CFO guided us for. Then there's a little other breadcrumb where, depending on how you might read it, and I put the quote down here, because the CFO said that vehicle electrical architecture and software development services paid by the Volkswagen Group are now reflected in Rivian's revenue and cost of goods sold. In the software and services segment, I just repeat, in a simplified manner, the services paid for by VW Group are now reflected in goods of a cost of goods sold. So this directly conflicts with her pure profit comment. I'm not sure if everybody gets that point, because if it's pure profit, there cannot be cost of goods sold um, for the services paid for by VW Group. So by adding all these accounting effects I explained earlier and her guidance on 30% gross margin, and these comments, it implies that my modeling is probably the most probable case. On top of that, you want to look at this evidence in terms of hierarchy. The highest hierarchy is the overall gross profit guidance, which is 30%. That is hierarchically the main point. And all the other comments are hierarchically below that. And so all of this implies what you see on this slide is basically the underlying, and her pure profit comment was maybe too much offhand. You might think now, AJ, you're really obsessed. Well, first of all, yes, that's true. But secondly, I think my logic is consistent. And the reason why I make a big fuss about that is because these details matter in terms of working out a relatively accurate forecast for the opportunity space of Rivian's profitability. So with that, we now discuss automotive, cost of revenue, cost drivers, and also for the S&S segment. So now let's discuss the margin impact. So first of all, the gross margin was 9.8% in the fourth quarter. And that's interesting in a number of ways. First of all, there was, for the first time ever, a positive gross margin. But there's a huge caveat, because the entire gross profitability, so the entire positive part, was driven by 299 million credits sales recognition in a single quarter, and this pushed it into 9.8%. That is completely not representative. So in 1Q, that's why we returned to negative gross margin, because 1Q, I expect a significant decrease in credit sales, and therefore the gross profitability goes down, with optimistically, again on all these assumptions I mentioned earlier, to see a modest gross profitability from 3Q, with a slight further improvement in 4Q based on continuing strong average selling prices and positive cost development. Also the revenue coming in from VW JV, of course. So all that adds up to a modest 2025 gross profitability, and this is precisely in line with management guidance. Management said they expect modest gross profitability for the full year, and these little details make a difference. This doesn't mean for every quarter, for the full year. So I think this is probably highly accurate in terms of how this year is going to turn out, unless there's some major currently unknown emerging. So next you can see how gross profit margin improves quite significantly. This is driven by, again, successful ramp of the R2 platform, and it grows through 2026, ending the year at 11.8, almost 12%, and then grows to almost 23% or above 20% in the second half of 2027. So now let's put this into context. This is a very high gross margin for an automaker these days, because global competition has ramped up quite significantly, and I think even if the US completely shields its auto market, given what's happening in the market, Rivian's still very small size. Even end of 2027, it will be still a very small automaker by automotive standards. So achieving that margin would be phenomenal. So this shows you the optimism built into this forecast. But to put this even more into perspective, maybe we should take a look at a comp. A comp is a comparable company. So what you're looking at now is the total GAAP gross margin, so the same metric we just looked at for Rivian, for Tesla. This is not a forecast, this is actually reported a gross margin, and just like in Rivian's case, this includes everything. In Tesla's case, of course, this also includes the energy generation and storage business, but we also have, and you can see this here on the left side, Tesla has also the service and other segment, which is very similar to Rivian's S&O segment. And then, of course, automotive, and in Tesla's case, automotive, Tesla usually calls it regulatory credits. It's the exact same thing as credits in Rivian's case. And then Tesla, because it's it's a larger operation, also breaks out automotive leasing, which is also included in Rivian's case, but it will be much, much smaller, and thus far apparently CFO didn't see any need to break it out. So this might come in the future, but long story short, this is very, very comparable. And what you can see is a number of interesting things. So in this chart, it goes back to 2022. In the beginning, you can see there was a 29.1% gross profit margin. So this is really, really high in the automotive world. And this was driven by various one-off effects that I discussed previously, so I'm not going to dive into now, years later, and was totally not sustainable. And so that margin had to come down basically, and the increasing competition, especially from Chinese automakers across various import markets, drove more intensifying competition, which drove to more margin erosion, etc. But keep in mind, Tesla is a very, very efficient automaker. Just look at the vehicles. They're very sophisticated, but Tesla tries to eliminate parts where they can, and they've done, I think, a very good job in doing so. So Tesla is in many ways a very, very high bar. And because the accounting in terms of gross margin is the same, we can really look at them as quite a strong proxy, and or comp, I should say. And what you can see is that assuming Rivian at a much, much smaller scale can achieve a 23% gross margin, let's just say that's a rich assumption, and let's just leave it at that. So with that little detour to Tesla, let's look again at this margin development. I think what this tells you is that the forecast is very aggressive in terms of vehicle margin development. I think I can't emphasize this enough, especially given all the uncertainty in the market. So because keep in mind, this includes all the credits, etc. So if anything happens to the credits, this margin is like completely unattainable. So keep that in mind, please, because this frames everything which we'll discuss later. So I finish here part 9, and hope to see you in part 10. Thank you for listening. Bye. Welcome back, everyone, to my Rivian deep dive. This is part 10. Last time, part 9, we finished off with discussing the optimism built into the gross profit projection. But before we dive deeper into gross profit, I want to discuss real quick here the average selling price assumptions that are underlying this whole forecast. Several times I already mentioned that I expect a continuous strengthening in average selling prices. In the R1 and van platform, for example, the average selling price was $86,000 in the fourth quarter of 2024. This was driven, as Rivian commented on, by a very strong product mix. Rivian had a significant uptake of the tri-motor version, which is a premium variant of the R1 platform, obviously. Rivian commented also on some mix effects with respect to commercial vehicle sales, so the van platform. They also dropped some comments on the expectation for 2025. All these comments have been reflected in modeling of the ASP mix with, as I said before, a slight optimism bias, and this then sees a sort of a consecutive tick up in average selling prices. Again, the drop in 1Q is driven by seasonal factors and of the one-off effects of the success of the tri-motor version, which based on Rivian's full year volume guidance is likely not sustainable. So the forecast reflects some normalization of that outlier ASP. So then when we look at the pricing, and keep in mind the scale here is made shorter to see changes more clearly. So the average selling price of the R2 is, my expectation is it starts at around $49,000. And my fundamental assumption in terms of modeling the ASP is based on a trim composition assumption, and put down here high level what that means. I believe that Rivian will be selling the R2 in basically 3 different trim levels. There's like an entry level version which has only one motor, it's rear wheel drive. Then you have a long range version which has all wheel drive, and then there will be likely a performance version. So basically very similar to Tesla. Of course, Rivian can call it that, they will apply different names to give these vehicles their own brand touch. And then what I did is I looked at Tesla's vehicle composition in terms of these trims and also pricing. And what I assumed is that Rivian would be selling at once a steady state is achieved, a similar would sell a similar distribution of trims, which probably makes sense. But in terms of pricing, I looked at Tesla's pricing and I applied a premium to all these different trims pricings in Tesla's case and applied them to Rivian, because I assume Rivian probably tried to come in, position itself as a slight premium to Tesla. But certainly at least in the beginning, because in the beginning when people launch new vehicles, they always can skim the excess demand, and this also makes sense to compensate for the higher costs initially, and that's why Rivian is most likely obviously not launching with the low-end trim, but most likely with the mid-level trim, the long-range all-wheel drive, and just like Tesla after 1 or 2 quarters launches then the performance version. So the first few quarters will most likely, as we saw in Tesla, benefit from a significant outlier trim mix to the positive, and then over time, as sales sort of reach a steady state, lower trim vehicles contribute a higher share, which then drives some erosion of the average selling price. However, the forecast, and this also applies to the R1 and van platform, over the longer periods also reflect some inflation adjustments, because if one thing is true in the automotive industry, vehicles never really get cheaper over long periods on a real basis, because they are, just like everything else, is affected by inflation, and that's why, especially when you make long assumptions, you should always have some kind of inflation assumption. Although in the last few years this was not true, but this was driven by inflated prior prices, driven by COVID, that preceded actually the inflation spike. But this is a different topic. So with that now out of the way, let's jump to gross profit, finally. So here you have the gross profit development. So this reflects everything, all the segments on a total basis. And let's just have a quick look at how gross profit developed. So in 2024, Rivian's gross profit was a negative 1.2 billion. The forecast results in positive 55 million. So what you see on this is not forecast. It's just the summation of all the other stuff we already discussed. So this falls out of the projection, just to be very clear. So if you feel that what was presented thus far is sensible, this is the mathematical result of all of that. So 2025, modest gross profitability for the full year. And as I said earlier, this is exactly in line with what management guided us for. Then 2026, there will be a substantial improvement to over 700 million. And then kind of explosive growth in gross profit to 2.4 billion in 2027. And again, this is driven by a highly optimistic R2 gross profit assumption, plus the effects of the back-end loaded VW JV, plus increase in credit sales. In other words, this is a culmination of this optimistic forecast. So keep that in mind for the next part. So the next part is this. This is operating profit. So to get to operating profit from the just mentioned gross profit, all you need to do is you have to deduct operating expenses. And operating expenses in Rivian's case comprise research and development, selling, general and administrative expenses. And unlike gross profit, and I just jump back here real quick, which will be positive basically from mid-2025 and then growing, there is still significant operating losses basically far into the future, despite positive gross profit. I repeat, despite significant improvements in gross profitability, there will still be significant operating losses. And before we dive into the drivers, let's just recap how material these losses are. So in 2024, Rivian lost almost 4.7 billion in terms of operating losses. So operating losses, everything you see here, but before non-operating items. But this is really 95% of the business. So this is operating is basically the business. Let's just simplify it a little bit. So the business lost 4.7 billion. The forecast implies another 3.3 billion loss in 2025. That loss shrinks a bit in 2026, but it's still over 3 billion at 3.1 billion, and continues to make significant progress into 2027, but still comes in just under 2 billion in losses. But again, assuming this very high gross profit margin can be achieved. And when you look at this operating profit, this is something Rivian never talks about. They always talk about gross profit, and they basically, they're not touching this topic with a 10-foot pole. They're always, what they're doing, they point investors to gross profit, because it sounds cool, profit, right? Positive gross profit, but completely avoid this topic. And then they always point people to adjusted EBITDA. That's basically, this is how they always frame it, which is a clever way of doing it. And if I was in Rivian shoes, I would do the same, frankly. But I will discuss later the problem with that, because ultimately you need to look at operating profit. It's a key metric, and when you look at this metric, you can see how it's still far from profits, even in 2027, even under these highly optimistic assumptions, frankly. And when you look at this trend, even when things go really well, even operating profitability in 2028 looks like far-fetched. I did not, full disclosure, not try to project into 2028, because I think this gets kind of wacky. But the trend we're seeing on these numbers, and we touch on this later, which is actually in line with Rivian's long-term kind of guidance, it doesn't look good. So right now, I don't know, it's hard for me to imagine gross profits. I mean, you can see here the significant quarterly trend in 2027. So if you kind of just graphically extrapolate this in your mind, you could see how the 2028 could get to break even. Break even means making no profit, making no loss. But again, this is 4 years out and includes credits, etc. Again, I'm just trying to provide transparency here. So this is all quite aggressive, because the bigger picture is, if this forecast is remotely accurate, there's basically no upside in Rivian for at least 18 months. Because in 18 months, we get to 2026, but from 2026 midpoint perspective, you're still looking at well over a year just losses. Okay, with that, I wrap up part 10 of this series. In the next part, we discuss these important operating expense drivers that create this huge discrepancy between gross profit and operating profit. Hi everyone, this is part 11 of my Rivian deep dive. We finished part 10 discussing kind of high level the context of the operating profit with respect to investors over sort of the next 18 months. But now we need to look at, okay, what is actually driving this significant gap between gross profit and operating profit. So first, let's look at it on a combined basis. Combined basis means including all the operating items. So this is the total operating expense. So just to recap, in 2024, Rivian spent 3.5 billion in operating expenses, and you can see Rivian actually brought them down. You can see a significant year-on-year decrease in the third quarter, and then another one in the fourth quarter. So, and you can see down here, the forecast expects for 2025 just under 3.4 billion, which would imply a 3.3% year-on-year reduction in 2025. And here's a very important point. Rivian told us that they expect an increase in both R&D and SG&A expenses in 2025. So some underlying increase. So this is this means increase, but we are showing here a decrease. So the reason why I assume a slight decrease is, I think I'm in line with the R&D guys. This is likely going up because of the VW expense that's being reflected in that line item. But I think the SG&A part of the business has a significant, let's call it underutilization of existing capacity, and therefore I don't think there is a huge kind of investment need. I think RJ really set is to kind of make the case he's investing in the business and is building for the future, that kind of thing. But in reality, he knows now he doesn't need to invest this year because volume isn't growing before there are more models, etc. So I'm more aggressive than what RJ tells us here. I think he's sandbagging here a little bit, and that's why I expected SG&A to be not growing very much at all. I do expect some R&D spend growth, but that's driven by VW JV. So on this slide, we now look at the R&D expense. So this is one of the main two components of operating expenses. And you can see that in 2024, Rivian spent 1.6 billion on R&D. The forecast reflects some very modest growth year on year of 4%, which is barely above inflation probably, and so it's kind of flat almost in real terms, even though Rivian is now expensing R&D expenses from the VW JV, plus obviously has to finalize design, not finalize design, but has to basically create all the designs for, has to finish development of the R2 platform, which means have to turn the prototypes into something that can actually be manufactured on a larger scale, plus also all the tooling that is involved with that, etc. So this is, I mean, if they can keep R&D at only plus 4% in 2025, this would already be quite amazing, to be honest with you. And so this is also in line with what they said. They expect some sequential, year-on-year increase in R&D expense. And then when we look at the SG&A expense, as I said earlier, I'm deviating here from management guidance. I'm expecting actually meaningful decrease of slightly over 9% year-on-year. So in 2024, Rivian spent almost 1.9 billion on SG&A. I expect this number to come down to just a tad over 1.7 billion, i.e. 9.2% year-on-year decrease, as mentioned. Then in 2026, I expect that number to kind of reverse again, but this is driven by obviously the R2 launch, because in the beginning of the R2 ramp, there will obviously be more selling activities. Also, the incremental volume has an effect on SG&A. So there is some direct relationship between SG&A spend and volume. But overall, this SG&A assumption in this forecast is very aggressive, because even in 2027, when the forecast expects volume to go through the roof, I expect some very modest SG&A increase of just under 5% for total SG&A of just over 1.9 billion. So if Rivian could deliver kind of this SG&A level, it would be quite amazing. And again, this is in conflict with what Rivian guided for in this line item. So this is, again, shows you the optimism of this forecast. So here on this slide, it provides you a relative perspective of how these two cost drivers develop. And a typical way that's often used in the industry to look at these numbers is by using what's often called efficiency ratios. So what you do is you simply put R&D expense or SG&A expense in relation to total revenue. Or if you want to refine the ratio, you just take the revenue that is touched by R&D or touched by SG&A, but in most cases, revenue is touched by these items. Most revenue is touched by these items, except for merchandise. Maybe there's probably not much R&D in merchandise expense, but either you don't have the disclosure or it's not a needle mover, and hence people typically don't adjust for that. But anyway, just as a side note for the analysts amongst listeners. But bottom line is, what you can see in this forecast is that when we look at these the latest available levels that are disclosed or inferable from the reported SEC numbers, you can see that so the dark blue line is SG&A in as of, and I should say this is actually the wrong labeling of this axis, because it should be months, because I'm showing this metric on a trailing 12 months basis. Trailing 12 months means I'm taking the sum of the last 4 quarters SG&A spend and divided by the sum of the last 4 quarters of revenue, and this is kind of a way to smooth out sort of sequential quarterly fluctuations to avoid the noise introduced by seasonality, etc. It just enhances sort of the the result that you can gain from this analysis. And long story short, when we do this, as of December 2024, SG&A spend as percent of revenue decreased down to 38%. And I think this is hard to read here, but for R&D, the percent decreased to 32%. And if we compare these numbers with 2023, December year end, so this improved modestly from 39% for SG&A, so 39 to 38, and but R&D improved a lot from 45% of revenue down to just 32%. And then when we look at the forecast, and this is just pure coincidence, implies that by end of this year, 2025, both R&D and SG&A drop to 30%. Then there's some temporary sort of slowdown in improvement, and this is driven by the R2 launch. There will be incremental R&D spend associated with the launch. Same for R&D spend, and then you see a re-acceleration in improvement of efficiency ratios driven by the ramping R2 that translates into incremental revenue, while R&D and SG&A increase much slower than revenue, and hence the ratio is dropping. And you may note that here at the very end of this, let's call it improvement curve or efficiency gain curve, the rate of improvement is slowing, and this is simply because after 6 or 7 quarters of selling the R2 platform, you would expect a slowdown in growth because, again, we assume launch in 2Q 2026. So there is small volume which grows very, very quickly in relative terms, and you have kind of an S-curve adoption. But then, of course, as you have the vehicle on the market for, at that point, well over a year, you should see some slowdown in growth. And this is basically then slowing down your efficiency improvements, even though your, as you will see, or as you saw in this forecast, if we just quickly jump back to R&D spend, is not growing very much here, quarter over quarter, and then the SG&A also almost flattish. So the slowdown you see is a slowdown in the revenue growth. So with that, we then can jump to profit before tax. And as part of profit before tax, we'll be discussing non-operating items, which are also a non-negligible factor in Rivian's case. But this is something we'll do in the next part 11. So thank you very much for listening. See you in the next one. Thank you. Bye-bye. Hi, everyone. Welcome back to my series on Rivian. In the last part at the end, unfortunately, I misspoke. Instead of saying next part is part 11, I meant part 12. This is part 12, so welcome back. So in this part 12, we'll be discussing non-operating items. So non-operating items comprise sort of net financing income or expenses. So net basically means you add up the income and you subtract the expense, and whatever left is your net amount. And then you have other non-operating items. But before we dive into these drivers that explain the gap between operating profit and profit before tax, the item we're looking at right now, let's just have a quick look. So unsurprisingly, as we'll find out in a second, this looks very similar to the operating profit development. These numbers are, when you look closely, are just slightly worse, but ultimately not much difference. Here's the reason why profit before tax looks slightly worse than the operating profit, and it has to do with a deterioration in the non-operating items. You can see there's almost kind of hilarious volatility in non-operating items in Rivian, but this is easily explainable by Rivian's convertible note. So Rivian accounts that note at fair value as typical. So any change in fair value is recognized in the P&L directly, unlike, for example, when you have a security that is held to maturity. And that causes these quarter-on-quarter significant fluctuations. However, these are all non-cash, and therefore it's really just noise to the earnings numbers. The forecast assumes as the forecast is neutral on this security, because it's kind of nonsensical to try to model this. because it doesn't change in any meaningful way any of the metrics that investors care about. So with that out of the way, so let's look at what is actually driving this development that you see here. So first, the first component. This is interest income. And you can see interest income was actually a major earnings driver for Rivian, simply because Rivian sat on quite a bit of capital. This used to be even a lot more when before Rivian depleted its capital reserves via negative cash flow. And in 2024, Rivian earned almost 400 million just in interest income. So this is literally just like in your bank account. You have some cash balance in your checking account. Some banks pay you some little bit of interest on that. In companies where you have some term deposit, you get a little bit more. And for companies, it's very, very similar. But instead of using term deposits, they often buy, short-dated bills, like 3-6 months paper. And they also earn some interest on their large company balances. So net result is what you see here. So up here in the green box, you see average cash balances, and again, cash balances is not only cash and cash equivalents, but also includes short-term investments. This is the proper way of doing this type of analysis. And you can see that in 2024, on average, the cash balance was somewhere between, let's call it, just under 9 billion and just over 7 billion. And this light green line actually plots the numbers that you see in these green boxes, and you can see how it goes down. You have some spike. This is driven by the VW investment. Then you see a few more little spikes. This is the net result of capital injections from one VW group plus DOE loan set off by negative free cash flow. And this is why you see over time the cash balance is going down. And if you remember in earlier parts of this series, we discussed that this is a major, don't want to call it mistake or shortcoming, but forecast allows, which is unrealistic, for the cash balance to drop into levels that are completely unsustainable. And that's why the forecast is significantly optimistic. So in other words, Rivian will have to raise capital, and the dilutive effects of these unknown capital raises from today's perspective are not accounted for yet in this forecast. So this is yet again another significant downside that we basically know is going to happen and not reflected in this forecast. The reason why I didn't include it was I did not want to pull completely out of thin air by the way a layman would look at it, a capital raise that nobody knows about right now. I know about it because I've run the numbers, but most people don't. And I did not want to risk discrediting this forecast by making such assumptions, even though in my opinion as an expert, this is completely unrealistic. Probably 99.9% of people who are looking at Rivian's right now 7.7 billion cash balance plus 6.6 billion DOE loan plus outstanding 3.5 billion from VW think, oh, you're crazy, they got tons of capital. So this is kind of the background. Point being, the situation is bad enough as it is, even without including those factors. And then just a real quick explanation. So the green box, as I said, is the average cash balance. And then you see the asset yield assumption. So the asset yield assumption is based on, and this is how you should typically do it, on the latest observable effective yield implied by the number, which is 3.8%. So in 4Q, and please note this is based on an annualized basis to make it more, let's call it understandable by when you look at interest rate. For example, when you look up a bond and you look at the interest rate of that bond, it's always stated on an annual basis. And to make it more intuitive, I show this number on an annualized basis. While of course the quarterly number that you see is not 3.8% on 8.7 billion is not 83 million. It's 4 times that. So basically, point takeaways. So this meaningful net interest income is because of this capital depletion decreasing, keeps decreasing. So now an astute observer might say, oh, but AJ, you're making a mistake. But as you say, they need to raise capital. So this capital then will boost the average cash balance, and hence this number will grow. So are you not understating the interest income? Yes and no. Yes, the interest income will be understated, but what you're ignoring is that in exchange, the the capital won't be for free. The capital will be equity, as I stated earlier, and this will increase the share count. There's just no way around, and hence there will be a dilutive effect. And I can tell you, no amount of interest income you will generate from the capital will make up for the massive increase in dilution. So you, in any scenario, will be worse off. So bottom line is, this certainly does not understate sort of that aspect of the modeling. So the second piece of these non-operating items is, the main piece I should say, is interest expense. And this chart is very similar to the other chart, but it looks at the average interest bearing liability, IBL for short, and the effective liability yield. So the effective liability yield was 6.5% in the fourth quarter. However, I think there are some one-off charges included in that yield that are in relation with the security that VW placed in Rivian. So I, yet again, optimistically assume actually a lower yield, and then when you look at the other drive, it's not only how much you pay for it. So the effective liability yield is how much you pay for your debt, all things considered. But then obviously it's driven by how much debt you actually have. And this is yet again plotted. First of all, the numbers are shown in the green box, and then you have the green line. So there is an increase in 2024 in the third quarter. This is driven by the VW security, which converted to equity. So that level went down. Then it goes up again, and this reflects the promised debt security, or should say debt injection from VW. And so in this little box, I'm not sure if you can read it. This is an excerpt from a Rivian disclosure, and this shows the promised debt from VW Group that is to be injected in 2026. So the forecast reflects that. So that is then Rivian's total corporate debt. And here's an important point. The DOE debt I have not included. I'm literally assuming there is no cost associated with this debt. Just to keep this in mind. I know this is a bit wild, but without getting too much into the weeds, so basically the cost of that type of debt is typically capitalized, and this is what's going to happen. So the dynamics of this type of debt are quite different, and I give here Rivian every benefit of the doubt, and this has some other ramification, but basically I'm modeling it, this loan, in the most favorable way possible, and that's why you don't see it show up here in this cost of debt calculation. However, it is included in the capital calculation, and it is included in interest income calculation. Again, giving Rivian here all benefits of the doubt I can possibly do as a financial professional. And by the way, the astute observer might realize that if you can read it, there are injections that differ in terms of where they hit Rivian at Rivian level or at JV level, since Rivian consolidates the joint venture. Where the debt hits Rivian at JV level or at holdco level doesn't really make a difference. It does make a difference to VW because debt security should be what's called bankruptcy remote. So Rivian, should they run into capital issues, they can't easily extract that money from the JV. That's basically the point. And there's a lot of other debt details to this topic, but except few people working in DCM and some debt investors, they won't care about that. So I skipped that part to make this video not too long. So this wraps up part 12. Hope to see you in part 13. Thank you very much for listening. Bye. Hi everyone, this is part 13 of my Rivian deep dive. We finished the part 12 with discussing interest income and some other considerations. So let's now kind of wrap up the P&L. Here just real quick, provisions for income tax. If you look at these numbers, these are millions, 3 million. It's like nothing. There's some detailed tax considerations, but there are absolutely no needle mover. It's mostly driven because Rivian is gonna stay loss making, so there is no meaningful taxation to be considered. So this basically means that shareholders' net income, because Rivian has basically no non-controlling interest, so profit and because there is no tax provision in Rivian, so profit before tax and shareholders' net income is identical, except for almost a rounding error. So let's review sort of what's the bottom. So, by the way, shareholders' income is often called like the bottom line, because it's literally the bottom line of the profit and loss statement. And when we look at 2024, the bottom line in Rivian was a loss of just over 4.7 billion. That's actually an improvement over 2023. It was a 12.3% reduction in the loss. 2025, this forecast implies a loss of just over 3.3 billion, a modest decrease to just over 3.2 billion in 2026, and a substantial decrease in losses to just over 2 billion in 2027. And I'm not going to go into the drivers again because this is what literally the last 12 videos were about, but you can see big picture, this is really, really bad. And because the company remains deeply loss making, you basically can't really do a valuation. So what you have to do in these situations, I'm a valuation expert, I sit on valuation committees in large investment banks and things like that. So I know a bit about this. So what you would do normally, you would have to forecast far enough out into the future till you have positive earnings, and you basically need at least 4 quarters of positive earnings before you can apply multiple valuation methods. However, multiple valuation methods not typically how you would like fundamentally value these types of businesses. You would use a cash flow based approach, but typically what you also do is you never want to use just one valuation method, and that's why it's complete standard, for example, in investment banks, that you do something like, it's often called a football field. In the future I might produce a football field to show you what I mean, but for brevity, just explain that it contains all the applicable valuation methods for that company and industry. And in Rivian's case, most metrics that would be applied by investors, they simply don't work until at least you make like a 10-year forecast to have enough sort of cash flows, steady state or something, and things like that. So long story short, nobody can really make a valuation right now with Rivian. It's all kind of pulled out of thin air because you just have to go too far out to get to metrics that work, because you need positive metrics, obviously. If we run real quick through the metrics that you would apply for a company like Rivian, of course, the super popular PE ratio, and PE ratio, like 90% of cases, people look at the 12 months PE, only works in many years out, as you can see in this forecast. There are no positive earnings. You can also use a PE on a next 24 months basis. Next 24 months basis, you take the next 4-quarter earnings in 12 months from now. So this is what 24 months earnings means, or sometimes called a 2-year forward multiple. You can obviously do it on a 36 months basis, but this is very uncommon and gets quite esoteric because it's too far out. And then, so this PE ratio, then you can do cash flow yield. So cash flow yield is simply, you look at the free cash flow of a comparable company and you divide that cash flow by the market value. That's then the implied yield if you bought the stock, basically. And then you would look at Rivian's free cash flow and you would divide that free cash flow by the yield. And that would then give you the implied value of Rivian. The problem is you can only do it if you have positive free cash flow. And as you'll see later in this presentation, there is no positive free cash flow. So again, the second method doesn't work. Third, what you can do is you take the very popular EV EBITDA multiple. So EV in this case means enterprise value. So the enterprise value is in a way similar to market cap, but what you do is you add up the equity value, and you can just use a simplification of market cap. you add all the debt, you add preferred stock or other claims to cash flows to the company. So that's why you would also add non-controlling interests, and then you have to subtract your cash balances. So the net result would then be the enterprise value. And because you have to add all these non-equity holders to sort of the enterprise value calculations, because the other component of the multiple that you want to calculate, the EBITDA, also comprises cash flows that are not 100% attributable to the shareholders. So you always want to have in a multiple, in terms of what is what forms part of the multiple, that it is consistent and you're not mixing up apples and oranges. For example, a really bad mix-up would be if you made like an enterprise value to earnings multiple, because earnings, they go to shareholders. So you have to use something that captures all the other claim holders, which also include the debt providers, and that's why you need to add to the equity value all these debt components and other interests. And that multiple actually starts to kind of work from 2027, and we'll discuss this in a second. Then other valuation methods I've seen people throw around, like price to book value, price to tangible book value, or price to TNAV as it's often called, or some revenue multiples. None of these multiples make absolutely any sense to anyone who knows how valuation works. I might do a video where I just discuss these valuation methods, because this exceeds the scope of this series on Rivian, but this is like people throwing out these multiples, they show a clear lack of fundamental understanding how corporate valuation actually works. And I, in my career, served as advisor to valuation committees, so I know a thing or two about this topic. And the reason why this also applies, why this is relevant to retail investors is, if you do not understand valuation or how institutional or large investors look fundamentally at valuation, you're always kind of behind. Because if you don't understand these topics, you never understand how large pools of capital think about investments. But once you understand, you can start to formulate trading strategies around these topics. Otherwise, you're always confined to just hoping to ride some meme stock, which in some cases might actually be the better strategy. So with that out of the way, so let's look at EPS, because ultimately this is what everybody cares about. And here you see basically the outcomes. So first of all, I explain real quick how this chart works. So here in this kind of purple box, you see the shareholders' net income. So these numbers up here, these are exactly the same numbers that you saw here on this slide. And then you see the other important metric for EPS, which is the number of shares outstanding. I show this here on a diluted basis. I'm not discussing dilution now here, but this is the correct way how you should always look at EPS. This is the green box, and again, this light green line shows the trend of these numbers shown in the boxes. So for example, Rivian had a share count just over 1 billion, 1.06 billion shares. And assuming Rivian can maintain a share price somewhere between $10 and $15 per share over the next few years, dilution basically adds, let's call almost 40%. The number of shares outstanding are being diluted by now 40% to roughly 35%, and because you can see it here, so we go from just over 1 billion to just over 1.4 billion in shares outstanding, and the primary driver is the various equity injections into Rivian that VW will be making. But on top of that, there is also some dilution from ongoing SBC, so share-based compensation of employees and especially executives. And over time, this also adds to the dilution of the stock. And as I said in the beginning of this video series, the dilution is actually helpful in Rivian's case because the EPS is negative. The losses are being divided over a larger number of shares, and that's why they make the losses look smaller. So this is great as long as the EPS is negative, but as soon as the EPS, the earnings start to become positive, this is a real drawback, because now the positive earnings are being divided over a larger number of shares. That is clearly not great. So why does it matter that the earnings, when the earnings number per share is not large, why does it matter? It fundamentally comes down to valuation. If the earnings number is small, and you try to work out whether a stock is expensive or cheap, as professional investors always would do, you would look at the share price and you would divide the share price by the next 12 months of earnings. So you add up the quarterly earnings for the next 4 quarters, and you divide the share price, and that would give you the next 12 months PE ratio, which is by far the most widely used valuation metric by pretty much any investor. And because the large number of shares divided down your earnings so much, the EPS became so small. Now the EPS with which you divide your share price is very, very small. And that's why the implied multiple will be very, very high. And because it will be looking very, very high, the conclusion is by every investor is, oh, this is a very expensive stock. There's not much upside, not going to buy it, not much demand, which basically leaves all the existing investors kind of stranded with a stock that is not going anywhere because the multiple is super high. And I think this is a topic that gains more and more traction amongst the retail community. I think some people are waking up to this reality, but this is just my observation in my little investor bubble. So with that, I want to wrap up this part 13, and I hope to see you in the next one, part 14, in which we will be discussing EBITDA. Thank you very much for listening. Bye. Hi everyone, this is part 14 of my Rivian deep dive. We finished off part 13 last time by discussing some valuation effects from earnings dilution. In this part 14, we'll be discussing adjusted EBITDA. This is what you see on this slide. So these boxes are direct kind of screenshots from Rivian's guidance. So you can see that Rivian guided in 2024 for a adjusted EBITDA loss of 2.7 billion. The actual number for 2024 was actually a tiny bit below that, was 2.688 billion. So and keep in mind, so Rivian provided guidance in February 2024, and this is what was delivered. So this was highly accurate, which is something I don't really believe in. So number one, it was either a fluke or Rivian had some leeway to sort of skew the result to kind of land ballpark in their guidance. Or it's a combination of both, and it was kind of a lucky outcome. Because if we look at Rivian's prior guidance history, for example, if we start with full year 2020A, so Rivian guided for a loss of 4.8 billion, and the company came in at 5.2 billion, and there was a gap of 9.8%, almost 10, let's call it 10%. They were 10% off in 2022. In 2023, they guided for 4.3 billion, but outperformed. They probably learned from their mistake. They were too bullish. They were 10% off. And as management, it's very, very important to retain your credibility. Otherwise, your stock is really under pressure, because analysts that don't believe you, and typically when they don't believe you anymore, they are overly bearish on you. And that's why I think Rivian sort of learned from that. And keep in mind, RJ at that point wasn't, super seasoned in his running of a public company. So he was quite new to it in a way. Of course, he's an entrepreneur for many, many years, but running a public company is a different ballgame. But so anyway, so he learned from his mistakes and clearly set the bar really, really low. So he guided for 4.3 billion. And he beat that low bar by 7.4%. So this then brings us to 2024, and as we just discussed, so Rivian completely nailed it. It's obviously a conjecture because I don't know, I haven't had a chance to discuss this with RJ, but I believe he obviously learned from the 2022 mistake, applied it successfully in 2023, and obviously then probably applied it to 2024. So him just nailing this probably low bar meant a number of things didn't go as planned, because he probably again, because of the experience, sandbagged this a little bit. And we now know, because 24 closed, there were various issues. Rivian had some supply issues. The transition to the new platform went well, but there were demand challenges. Rivian, as many people might know, also was forced to use more aggressively attractive leasing rates and other levers of increasing demand. So it was not only for Rivian, but everyone else, a very difficult year 2024. And this is why he just landed on the 2.7 billion he guided for, is in my opinion. And the reason why this is relevant for this forecast, because this video is absolutely not about the past, but the past is often very helpful to inform the future. If we now look at the guidance for 2025, which you see here, again screenshotted from the disclosure, adjusted EBITDA, they guide us to a loss of 1.7 billion to 1.9 billion. So first of all, the main observation is, oh, that's a lot less than in 2024. This is great. And the second observation is that this is for the first time a range. In all prior years, since Rivian basically handed out these guidances, there was never, not a single time, a range. This indicates to me that there is heightened uncertainty in Rivian's forecast, because previously they always felt comfortable to give you like one number, and in 2024 they completely nailed that number. So why now switch to a range? I think Rivian just sees a bunch of clouds on the horizon, and we discussed a bunch of them already. Political situation in US, etc. Blah blah blah. I think there's just a lot of uncertainty, and they just want to play it safe, not to repeat the mistake from 2022, from which they clearly learned. So in this forecast, as I showed you, I've been using soared quite aggressive. Aggressive means optimistic assumption. And the forecast that you have seen throughout this video series ends up in a loss of just over 1.7 billion, which is just slightly over the optimistic end of the guided range of the CEO. And here comes the wild part. I got to this result by not even calibrating the model. Model calibration means that you try to build a dynamic model, and you have only some, let's call it, bottom end of the model metrics provided by the company, but you need some interim metrics. So what you do is you calibrate, or in reality what it means, you goal seek certain assumptions in your Excel model, so that ultimately when you add everything up, you end up in the guided number. This is model calibration. And I ended up in the number that you see right now on the slide, 1.752 billion, before model calibration. When I built the model, I totally expected I would need to sort of go back to my assumption and revisit some to hit that number. To be spot on tells me, this is basically spot on. This tells me a few things. That range is really kind of their best guess. I don't think there's a lot of sandbagging included, and getting below 1.7 billion losses will be very, very tough, because this focus is very, very optimistic. But then there's part two. Part two means, because this forecast is so optimistic, one, I might be wrong. The forecast is actually not that optimistic from Rivian's perspective. But given my global automotive coverage, I feel quite comfortable that my forecast is quite optimistic. So this is probably not it, but there's a possibility that's the case. So I might falsely assume my forecast is too optimistic. But then the second one is, there is somewhere a positive item Rivian hasn't talked about, and this would be in line with how they played it last year, because if the people who follow this topic very closely, they might remember that last year when the stock traded really low, crossed it. Low is relative. So if the stock touched like the lows in 2024, that's a better way of phrasing it. So Rivian was under pressure. So RJ made a brilliant move. He basically all of a sudden told everyone, oh, we're going to be gross profit positive in the fourth quarter of 2024, which blew everyone's mind and was like the main topic, and sent the stock flying, because nobody had this on the radar, because the company was just making too much loss on vehicle sales, and costs were too high, yada yada yada, that nobody would ever forecast such an improvement. And so this blew everyone away. And the trick was that that he knew the credit sales, and he would recognize I think 95% of the full year 2024 credit sales in one single quarter, instead of recognizing a bit as you go, as Tesla does, for example. So if of the total amount of 325 million, he recognized 299 million in the fourth quarter, and it's all profits. So if you just apply a margin of 20% on that, this is like you have like an extra, what would that be? That would be like having an extra revenue stream of 1.5 billion at 20% margin. That's the equivalent of this 299 million credits recognition. And I'm sorry, I have to laugh about it, because this is so crazy that he didn't tell the market that the gross profit was driven by a ginormous end of year this hugely honeypot item recognition is so incredibly misleading that it makes me laugh, and the fact that virtually nobody figured this out was wild to me, because and I posted about this. I posted about this very fact. I literally said, I think in May or something, like relatively shortly after he made this guidance, I said, I'm expecting that he concentrates all the credit sales in one quarter. This is precisely what happened, and only because of that, so that profit was achievable. So now coming back to this here, because my forecast is so optimistic, and I'm getting really within that range, I think when we discussed earlier the margin in the S&S segment, specifically the 30% margin, that doesn't line up with the comments that the CFO gave us. I think this is maybe the honeypot they are not telling us about. So if that speculation is correct, and that's the honeypot they want to use to kind of smooth out any negative blows and still somehow manage to get into the guided range, we would see in the next coming quarters a significantly higher S&S margins. So S&S is the, just to repeat, software and services segment, the new segment, should be significantly higher than 30%, or at some point in 2025 we see one huge bump in that segment's gross margin. But anyways, so in the next part I will discuss sort of the big picture consideration about this very point. So thank you very much for listening. So this was part 14. See you in the next one, part 15. Bye bye. Hi everybody, this is part 15 of my deep dive into Rivian. We finished part 14 talking about a potential honeypot hidden within Rivian's guidance. I explained how my highly optimistic forecast results in the optimistic end of Rivian's guidance, even though the first time introduction of a range suggests some uncertainty in their forecasting. The management also pointed out various potential risk factors to the outlook. And to kind of dive deeper what this honeypot might be, let's jump back to the discrepancy that I pointed out earlier. So this slide from an earlier video, I discussed why we have a discrepancy in what the management said. I'm not going to recap what I said here, but so big picture, the honeypot that Rivian is not talking about could be this. So the gross margin on the VW JV revenue recognized. I'm, as I said previously, forecasting this with this gross margin assumption. The gross margin is actually not an input factor, it's an output, and because the gross margin is driven by running off the deferred revenue liability that Rivian created as of December, 1.96 billion from the VW JV, and by looking at the total segment's gross profit margin, 30%. By stripping out the service and other segment, you can infer how much gross profit the VW JV has to generate. And combining this profit with the runoff of the deferred revenue liability you can plot this implied gross profit margin. However, based on management commentary, this should be 100%, but it doesn't line up with the 30% margin as I explained previously. For that reason, the discrepancy could be the honeypot that I was banging on about when I talked about the EBITDA. However, the key takeaway is when you look at this gross margin profile, what I'm saying is that basically a little over half of the deferred revenue turns into flows as gross profit through Rivian's financial earnings. The total deferred revenue is 1 billion. So if this is truly the honeypot that is kind of implied, then there is an incremental 1 billion in gross profit, or call it pure profit, hidden in Rivian's forecast. But here's the big picture. Because losses are still so enormous, and because this gross profit does not emerge just in 2025, but this runs off over 4 years as the CFO guided, I say they probably can do it much quicker. I forecast 3 years. This 1 billion is distributed and according to Rivian, back-end loaded over this at least 3-year time frame. So this means there is roughly a, call it 300 to 400 million upside at most in 2025 or 2026. Now when we jump to the operating profit, you can see on 3.3 billion in operating losses in 2025, 300 to 400 million is not going to do much. It's like a 10% delta roughly. And the same is true for 2026, where they still have 3.1 billion. So even if this is an underestimation here in my forecast, this would not dramatically change the picture. Yes, 10%, 15% deviation is quite meaningful, but given the enormity of the losses, it's still not changing the fundamental picture of the company. So the main aspect to this is really not to buy basically Rivian's BS, because if you remember, the 4Q 2024 profitability, gross profitability, was exclusively driven by a one-off, which they didn't disclose to us. They just said gross profitability. Hence, they did quite well using this clever trick. So now I conjecture a little more. Let's assume this honeypot is really hidden here in the release. So what they might be doing, they might be strategically release that honeypot to boost gross profits, because again, it doesn't move the needle in operating profits. So they will always keep pointing to the gross profits, but my advice to you as an investor is you need to look past the gross profit discussion. It's a red herring, as I hopefully this presentation demonstrated to you, because I think Rivian will be using this honeypot if it exists. Again, there's a lot of conjecture here, but based on everything that is close told us, there's a chance there is some item here. Otherwise, my very optimistic forecast nailing the lower end or the optimistic end of the guidance doesn't quite make sense. So big picture, what I want you to take away is, if there is a gross margin or gross profit surprise, look very closely at operating profits. This is what you should be looking at. The other stuff can be gamed, but operating profit is much, much harder to game. So with that out of the way, let's talk about free cash flow. Because ultimately, over the long term, free cash flow is the ultimate metric. All other high-level metrics have some or higher degree of accounting noise in them. So this chart is quite busy, so let me just walk you through how this works. So here down in blue, you see the quarterly free cash flow development. This is shown in millions, and when you look at this time series, it looks a little odd. It's all negative, except there is one massive positive outlier. So actually, it is true, Rivian's free cash flow was positive in 4Q, but not even Rivian dared to talk about it. And you know why? Because this was also entirely driven by a one-off item. Rivian recognized in one go the entire upfront payment for the next 3 to 4 years, or they didn't recognize, it's the wrong way to put it. They received the cash from VW already. So VW transferred 1.96 billion in payments to Rivian. So Rivian got all the money. It's very similar to Tesla when they sell FSD, but it's not quite ready. So let's say Tesla charges you, let's say 6K for it, but it's, let's say 50% ready. So they only recognize 3K in revenue, but put the other remaining 3K onto the balance sheet, create a deferred liability, and as they satisfy more of the performance obligation, they will release some of the 3K set aside in the P&L over time. This is precisely what happens in Rivian's case. So they got the 1.96 billion in December, created a reserve, and as they deliver milestones, they will release some of that reserve in the P&L. But importantly, they already received the cash. The cash sits on the balance sheet and is therefore, once they recognize it in the P&L, a non-cash earnings contribution. So anyway, so you see this cash flow, so you can basically ignore this 856 billion positive for that reason. And if you strip out this one-off item, the free cash flow is actually pretty much unchanged quarter over quarter. Rivian kept burning through 1.1 billion in cash. So what does burning cash mean in terms of negative free cash flow? It means that your operating business is basically, think about, okay, what's the purpose of your business? By pursuing, executing on your purpose of your business, the cash that business brings in, less what you invest to keep the business running and make sure you have a future products, etc., minus that cash called capex. What's left is what your business generates. That's why it's called free cash flow. So now you have the free cash. Now you can do some other stuff with it. But this is the free cash flow. And in Rivian's case, the business is simply deeply loss making, because, as I always half jokingly say, Rivian is selling $2 bills for $1 bills. And then please note down here the formula for free cash flow. I said this earlier, this is operating cash flow less what you spend on capital expenditures, or you can call it investments. And this results in the free cash flow. And in the next video, we will discuss the drivers of free cash flow. Thank you very much for listening. See you in the next one. Bye. Hi everyone, welcome back. This is part 16 of my Rivian deep dive. In the last video, we closed with discussing high-level free cash flow. In this episode, we discussed the drivers of free cash flow and a few other things. So down here again, you have the formula. Keep this always in mind. And now let's look at some typical key free cash flow drivers in any automaker. This is the change in inventory, and the change in inventory is driven by the relationship between vehicles delivered and vehicles produced. Here on this chart, you see in the purple boxes the vehicles produced, and in the green boxes the vehicles delivered. And here on the top, these changing size boxes illustrate the vehicle inventory. So in every quarter, when you produce more vehicles than the vehicles that you deliver, your inventory goes up. Rivian, just like Tesla, doesn't have a dealership model. This means when Rivian makes a model, but it doesn't deliver it, it sits on Rivian's balance sheet. This is very different from other automakers which have a wholesale model, which means they produce a vehicle, they ship it off from the factory, and at that moment they book the revenue. From their perspective, it's delivered. Even though in many cases the vehicle ends up sitting for months on some dealer lot, it doesn't matter. The automaker will book the revenue. So when we look at Rivian, so let's take a quick look what actually happened before we look at the forecast in 2024. Rivian started the year with almost 12,000 vehicles in inventory. In the first quarter, they produced 14,000 vehicles, delivered 13,600. Sales kept kind of steady in the second quarter of 2023. Then there was a significant drop in 3Q 2024 for some other issues I'm going to dive into here. There was overproduction because they produced 13,200 vehicles. So that's why you can see that the inventory increased slightly after it decreased before. And when the inventory goes up, this consumes capital because you spend money, you spend cash on making the vehicle, but now you can't sell it, so you have to put it on the balance sheet. So the cash that you spend is recognized as a cash outflow and increases the negativity of cash flow. So this is what happened here in Rivian's case. Then, as we discussed earlier, fourth quarter you have to exclude because the number is completely irrelevant because of this huge one-off item of almost 2 billion deferred revenue. But the big picture point is that Rivian had a cash burn of almost 2.9 billion in 2024. All things added together. But again, this includes almost 2 billion of deferred one-time revenue. This is not recurring. This is the VW JV revenue expected for the next 3 to 4 years. So it is a one-time cash infusion. So if you adjust for that, the 2.8 billion down here, or 2.9 billion rounding correctly, is 4.9 billion on cash burn. So this is a billion. So Rivian burned nearly $5 billion in 2024. Again, the operating business brought in 5 billion too little to pay for everything in terms of cash. So now, with that in mind, 2025 makes a lot more sense. You can see, oh, cash burn is 4.3 billion. Because without that knowledge, you might think, oh, they only burned 2.9 billion and HA forecast, you crazy, 4.3 billion. No, the adjusted number is almost 5 billion. And that's why you actually see a significant reduction in cash burn is reflected here in this forecast. So, and then let's look at this at 2025 a little bit more closely. So Rivian told us they expect deliveries of only 8,000 vehicles in the first quarter. This is actually a long-term low. Rivian justified this with seasonal factors, and yes, it's true, there are seasonal factors in the auto industry. They also justified this with high concentration in the California market, and they also even mentioned wildfires affecting their demand. Okay, let's assume that's correct. But Rivian also told us they expect like 14,000 vehicle production, and they overproduce so many. And this is why you see the inventory going up a lot in order to prepare for the long-announced factory shutdown in the second half of 2025. So what they're doing is they're overproducing in the prior quarters before the factory shutdown to have enough inventory to last them through low production periods. So, and this is why you have this increase in inventory and then it goes down again. My assumption is that the factory shutdown takes place end of 3Q going into 4Q and will be wrapped up over a 4-week period. So that's why you have not like a complete decrease in production. So it reflects basically 3Q takes some blow to production and then also 4Q, but 4Q assumes a quick ramp up after the production shutdown. And then in 2026, you also see some increase in inventories. This is in relation to the R2 platform launch, because often when you rent a production, you have simply the vehicles can't be delivered on time. So that's why the underlying model assumes some mismatch of production and deliveries, which then also drives the vehicle inventory. Further, in just prior to the R2 launch, Rivian might also build a little bit more R1 product. So once the R2 launches, they can focus or reallocate resources to help out on the R2 lines if need be. This would be a prudent move, and I've seen this from other automakers. And then later into 2027, you see how global inventory increases peak levels, but still, relatively speaking, is relatively low, because then of course the R2 has already scaled into meaningful material volume, and there's just a lot of product in transit, unfinished goods is not included here, but there's just a lot of vehicles, completed vehicles in transit, and also Rivian talked about increasing their selling footprint, etc. So there will be showroom vehicles, etc. plus and vehicles waiting for delivery. So there's just naturally an increase of the vehicle inventory, and this also consumes capital. So this capital consumption, this increase in vehicle inventory is capital consumption on top of net losses, and it represents a main driver of operating cash flow. That's the first key metric for the free cash flow calculation. But then the other one is capital expenditures, and this will be the last piece we'll be discussing in this video series. So the CapEx projection in this forecast leans heavily on management guidance. So for 2025, Rivian told us they expect 1.6 to 1.7 billion in CapEx. The forecast here again assumes optimistically Rivian spends at the low end of their guided range. So the forecast assumes 1.6 billion. This is a 40% increase year on year, but again, this is management guidance. On top, just a few days ago, management told us we expect to have a year-over-year increase in CapEx 2026. So they already know they're going to spend more, and these things tend to be quite accurate because they have quite specific product launch schedules. They have very detailed plans on everything. They literally know what machine will be installed in a factory that is yet to be, or a building that's probably not even in existence right now. But long story short, this is typically quite accurate. But they didn't tell us the exact number, and I assumed a 20% year-on-year increase. But again, 2026 is significantly driven by the R2, so this is the key driver for that. And 20% looks like a lot, but it looks quite high because, again, we are using the low end of the guided range. So if they come in at like midpoint, this 20% immediately goes down to 16%, even though the number doesn't change. It's still 1.9 billion. Hence, this CapEx projection is still probably not very aggressive. And then 2027 is basically driven by the same assumption, another 20%. As Rivian tries to scale to significantly larger production volumes. Of course, this assumes that there is a significant take-up for the model, and this is consistent with this entire forecast, because this forecast assumes Rivian can achieve a very high gross profit margin, which also implicitly means that there's good demand, otherwise you cannot sell vehicles for this price. Or for a price that would generate such a high gross profit margin. Again, this shows you another degree of sort of optimism built into this forecast, but capacity expansion consumes capital and is cash flow negative. So this brings us to the end of part 16. I decided I make one more part and we'll just go high level to the key points for investors. So this was part 16, so see you in the final one. Thank you for listening. Bye. Hi everybody, this is part 17, and this will be the final part of my Rivian deep dive. In the last part 16, we discussed the capital, sort of the CapEx outlook, and in this final part I want to jump back to the very beginning of this video series, here to the financial summary. So before I get into it, keep in mind everything I talk about is from a investor perspective, which is just a euphemism for saying from I want to make money perspective. So the question is, okay, with the knowledge you acquired by sitting through this extremely long video series, what is the upside for me? What have I learned to make money from it? The answer is that you have now a sense of the opportunity space for this company. What does opportunity space mean? It means how much upside is there relative to downside. I still don't understand. In this presentation, I think it's abundantly clear that the upside in Rivian is highly limited, except for events that nobody has on the radar right now that may or may never materialize. However, based on what we know, and by extrapolating what we know, I have a decent handle on, and based on what management told us, there is very little upside, but there is significant downside risk. So the bottom line is, of all of this, the smart investor equipped with this knowledge can exploit irrational share price movements. And anyone who looked at Rivian's share price development will have taken note of the fact that Rivian is a highly volatile stock. What is a highly volatile stock? High volatile stock is a stock that frequently has a very significant relative share price change. Relative share price change means in terms of percentages. It's not uncommon for relatively calm news days to see a move in Rivian of 3, 4, 5%. Since the upside in the stock appears to be limited by operational performance, this suggests a specific type of trading strategy. In the coming days, I will share my thoughts on what this type of trading strategy would look like to take advantage of the knowledge gained from this type of analysis. This is not trading advice. With that, I close this video series. I hope this was informative and shed some color on Rivian. And before I let you go, the primary reason why I cover Rivian is I I saw a number of people losing a lot of money investing in the stock because they fell for some very poor reasoning that was not based on any kind of fundamental analysis. And by providing this type of analysis to virtually anyone who takes the time to look at it, I want to make a contribution to leveling the playing field. In this video series, the type of research you looked at is typically the domain exclusively reserved for institutional investors, hedge funds, high, or should say ultra high net worth individuals, and other high value investors that have access to highly paid advisors. With that, thank you very much for listening, and stay tuned for my analysis of actionable trading strategies. Bye.